Welcome, options traders. I stumbled across an interesting article in the Wall Street Journal the other day, and I thought it would be interesting to take a look at it. It's applicable more to agriculture and commodities, but there are definite parallels for investing, and especially for all of our new investors out there, certainly helps to understand the Cobweb Theory, the dark side of looking forward. So let's take a look at the Cobweb Theory. And this article started out with a family in Mississippi, the George family, that was a huge, history of farmers. And I think they were doing cotton and cattle and were now doing soybeans. And decades ago, they come across this new federal program that offered farmers money to reforest depleted land. So they came up with a great idea and they said, hey, let's forget about all this farming stuff. Let's plant trees. And we'll come back and revisit it in 30 years, and that's going to be our retirement. And so what the article was showing is that, unfortunately, thousands of Southerners planted trees for retirement. So the strategy didn't work. Everybody went to plant trees. And anybody who understands economics would have known that this is a very common problem, especially in the agricultural markets. But again, there are parallels for investing. But it's especially disruptive for agriculture. And what you'll notice if you follow a lot of the commodities, that they tend to be low prices one year, high the next, low the next, high the next. They just kind of oscillate back and forth. And there is a theory called the Cobweb Theory that explains that. So let's take a look at it. And what we're looking at here is our basic supply and demand that we see in economics. The green line is the supply line, upward sloping from the lower left to the upper right. And the blue line is the demand line, sloping downwards. And the way that we read this is very simple. We've got price going on the vertical axis. We have quantity on the horizontal, or volume, or amounts, anything like that. So let's say that we have a certain price in the market, and we therefore get a certain supply. People have an incentive to create only so much at a given price. However, if the market price is higher, then the suppliers react and they say, hey, this is great. We can make more money. We're going to kick it into a higher gear. And so they will supply more, and guess what? We will end up with a higher quantity. So suppliers react positively to higher prices, and they will in fact produce more. On the other hand, if we look at the demand curve in blue, we get the opposite result. This is the curve that you and I respond to as consumers. So let's say that there's a certain price in the market up here, maybe at $10, and we're only willing to buy so much. However, if the price comes down, now we follow out to a new point on that blue curve, and we see that the quantity or amount that we're willing to buy increases. So again, there's this inverse relationship. Suppliers act positively to rising prices. Consumers act negatively to rising prices. And vice versa. Consumers like it when prices come down, and the suppliers don't. But back and forth we go with this supply and demand until we hit an equilibrium, which I think most of you know who have had basic econ, is right here where X marks the spot. And that is the price, what we should see in the market. It's a price where everybody who wants to supply can, and everybody who wants to buy can. We have no surpluses or shortages. In other words, it's an efficient allocation. So let's just say hypothetically that this is maybe $5 and we have 100 units sold per unit of time, whether it's a month or a year. So this is where we start. This is where our farmers kind of base their decisions. So the Cobweb Theory starts, and there's a lot of different ways we can get it started, but it starts by having some type of a disruption. So let's say if there is a supply disruption, maybe there is a drought, and we find out that instead of 100 units that we plan to get, we have maybe only 70. Well, that's bad news on one hand, but it's good news for the people who did survive, because they find out they can get a much higher price. They're not going to get that $5 price. Maybe it's trading up here for $8. So they go to market because, remember, they're going to sell at the highest point that people are willing to pay, and it's right there where that red line touches the blue. But here's the problem, and this is really the essence of the Cobweb Theory. When the farmers go to plant next year, they base their decisions based on today's prices. So they're going to say, hey, this is trading for, let's say, $8. That's great. At $8, sure, I'll go ahead and plant. And so everybody jumps on the bandwagon and they plant according to their own supply curve. And they're saying, at this price, I'm willing to supply this much. But then there's another problem. When they get to market, they find out there's an overabundance, an oversupply here. and they find out that at this new quantity, maybe at 130 units, people are only willing to pay this much. That's the only price that will equalize that. So now they got a high price last year, and this year they get a very low price. So when they go to plant again, they say, well, it wasn't such a hot crop last year. I'm not real motivated, not real encouraged to go ahead and plant this commodity, whatever it was. And so what am I going to do? I'm just not going to be real motivated. I'm going to reduce my supply. So they're going to say, all right, I'm only willing to do this much. But then they find out, because everybody had the same idea, we're undersupplied. And they now can go to market and get this higher price. So now again, we went from a lower price to a higher price the next year. And then they look back and they say, hey, it was a pretty decent year. Let's go ahead and supply some more. And then they find out that they can only get this much the next year. And what you'll see is that it just keeps going back and forth and back and forth, and eventually looks like a cobweb. Now, there are many different types of cobwebs. This is one that's called a convergent cobweb. There's a divergent one, and there's reasons why they happen. But the main thing, this is the most common in agriculture. And you will see that eventually we hit equilibriums, but there's a lot of oscillations back and forth. And the problem is that a lot of the farmers don't survive this. So if the George family had understood economics and cobweb theory and understanding that people are going to respond to incentives, they wouldn't have been led to have this quote saying that 3 decades later, the trees are ready to cut, and Mr. George is learning how many other Southerners had the same idea. So how can we use this as investors? Well, when you see sensationalized headlines like NVIDIA stock rises after Evercore rating company here boosts the target to 400, representing 50% upside. Well, the stock was trading at 200. This company had a 300 price target on it before. Now it jacks it up to 400. Well, guess what? Everybody's going to rush to buy it. The crowd is going to say this is where the money is. And this is where the smart investors say we need to also fade the market. We need to sell into this strength. And this is where options will really shine. We can sell some very nice high-priced options into this volatility, but we can also use a stock replacement strategy to get some leverage to also capture the gain. And the cobweb theory also sheds some light on why stock prices are so volatile. Very similar. People get over anxious and the price goes too high, then we fall back too low, we go back too high. There's fluctuations around this long-term average. And that's why I always tell traders focus on the long term. We can't predict the oscillations. We know that they're there, but what we're after is the long-term trend. That's the equilibrium. So if you have any ideas about the next technology that says, for instance, crypto miners earn $125,000 every 10 minutes, and here's how you can retire rich, understand the cobweb theory. Everybody's going to jump on this. So you're going to see 2 reactions come out in full force. First, there's going to be a mad dash to buy the equipment, and that means people are going to be paying super high prices, going to be tough to recoup from, and that's going to lead to headlines like this. People slinging overpriced Ethereum rigs on Craigslist. Everybody wants one, and in their mind, there is no price that's too high. They got to have it because this is where the money is. But if you understand the cobweb theory, realize that everybody has this idea there's going to be a glut, and that's what's going to lead to headlines like this. So these are some great headlines to take a little bit of experience to apply to your investing. Understand that people will react to news, and that is going to change the supply and demand. The thing that you need to do to succeed with investing is not to follow the headline, but is to figure out how people are going to react. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab from OptionsA2Z.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.